Hello guys, and welcome to episode 8 of Kenya's Market Map. This is where we discuss business and finance happenings in Kenya and in Africa at large. And today, we've seen actually this week a lot has happened. At the NSE, things have been quite quiet, and the likes. So firstly, if you're listening to us on YouTube, please subscribe and share. You can also follow us at Kenya's Market Map on LinkedIn, on Twitter, at marketmap_KE, and on our website, kenyasmarketmap.com. Also, you can find our podcast on Spotify, Google Podcast, Anchor, and all the other places. I'm your host for today. I'm your captain for today on this flight. With me, I'm Keegan Kiplimo, and with me, my first assistant
yes.
is Easter.
First officer. Easter Fanning.
And then we have ule mtu wa kupima temperature for those people who are entering into the plane. Dan.
Daniel Kalia.
So, gents, this week we'll be talking about the EABL corporate paper. We'll be talking about ABSA and the single obligor, quagmire that has occurred. Also, we've seen MTN, their plans to list on the Uganda Securities Exchange. We've also seen reports about the diversion of around 18 billion that was meant for fuel subsidy, which came to a close in September. This money was diverted by Treasury to other things. We'll be talking much about that.
Surprise.
Not at all.
We've also seen Cyton. Two of their products are actually under demonstration.
Surprise.
Easter,
No, that's actually a surprise.
I knew Easter had to say something,
That's
but
actually a surprise. We'll get there.
We'll get there. We've also seen Parliament. It has approved the KQ deal to access more of the US market. There's a whole conversations about what we call BASAs, the bilateral air service agreements. We'll be talking about that too. And today we've introduced a new segment that we'll be having every other week.
Makofi.
Makofi. Should do Makofi.
Ama ni bado.
Yes. It's called Stock of the Week. We'll be picking one stock and discussing about how it's been performing, to inform you more and more about the Nairobi Securities Exchange. So today we want to do things a bit different. Okay, we want to start with highlights. We normally, if you listened to our previous episodes, we've been having our highlights towards the end of the show. Today we've bring it at the start. So I'm going to go around. And thank you so much, guys, for supporting us. If this is your first time listening to us, this is episode 8. We have 7 other episodes. We also have a special edition on the Kenya Economic Survey of 2021. Check that out. To kick us off today, EABL this week, they issued a corporate paper. A 5-year bond at 12.25%. They're looking to get 11 billion, right? So this is actually, I need to state that this is after, I think, around 5 or 6 months retiring their initial bond that they had. And it was at around 14%, close to 15%, which was huge. We saw the CFO saying that, they were paying a lot for that, and it did not make sense, to the shareholders and to the business. So that's one of the reasons why they retired it early. So for this, my question is, actually, if you look at the reasons why they're saying that they need to borrow is for them to restructure some of their loans, for them to repay some of the loans. Why does the EABL need to do this?
Because it's too expensive. It's very expensive.
Are you worried as an investor? Should you be worried?
Well, this is not a 1 + 1 giving you 2 sort of arithmetic, because what's the rate for this corporate paper that has been issued? This corporate
12.25.
12.25. Yeah. What is the loan that they're going to refinance? What's the rate of that? It's less than that.
Yeah, right? It seems to be 8%.
I think what they're going for is not just the cost of capital. They're going for the, concessionality. That is the length of duration of repayment for this loan. It's better compared to what the bank ABSA wants from them. Understand? And then the other reason they were going for this loan is to improve their working capital. Yeah, if you look at their working capital, that is the current liabilities deducted from the current assets,
Yeah.
they're in a negative position to mean that the current liabilities are more than the current assets. So that poses a very huge liquidity risk.
Yeah, I mean,
And if you look at their current
I'm
liabilities,
shocked. I mean, Easter is saying that, and I'm shocked.
if you look at
Yeah.
their current liabilities, the chunk of it is, well, the normal trade payables. But then the next after that, the next, if you rank them according to the size, by size or figures, the next is borrowings, which stands at, is it 9 point something? It's so.
Because
We're really not sure about their liquidity position.
I saw that in an interview, the CFO was saying that one of the issues is that their debt that they currently have is very short term, and they want to extend the term of that. And for me, I can understand, because I can see why they're in that position. Because if you look at EABL in the recent past, they've done some capacity expansions in Kenya. In Uganda, they actually bought Serengeti Breweries Limited in Tanzania. I think it was around 6 billion. So I see why they need to do this.
And then there was a Kisumu plant, was it?
Yeah, I think there's an expansion there, and we also saw that they have plans to go green, for solar and the likes. So I mean, I would understand why they would want to restructure to a longer one. But for me, Kalia,
but this is not really long; it's medium, because it's a 5 year.
Yeah, it's medium. It's 5, but it's longer than the kind of 2 years they've been having.
Which, as an investor, should be a concerning point, because you're like, why did you take this short-term loan if you know that it was going to run you into problem? Were you desperate at that time you're taking it? You get? It's like that now when it matures, now you're starting to look of ways of restructuring. And you go for more expensive debt. In as much as it is longer term, it's more expensive. So as an investor, though Rispa Ogenga is very, she knows her stuff.
Yeah, she's a good brain.
So I don't know what's going on there.
Okay.
Kalia,
but let me ask you, Kalia, do you think EABL is going to retire this corporate paper earlier, just like they did for the previous one? Because 12.5%, 12.25% for me is still high for a corporate.
Yeah, it's high. And I think, I don't know, okay, it's a small sample size, but it's like I'm getting the feeling that when a company retires its bond earlier
than expected,
they have plans of going back to the market.
Yeah.
Because the EABL did that, was it 6 months ago?
Yeah,
not long
6
ago,
months
they
ago.
retired. And now they're in the market. If you remember, last year, Centum retired their bond at group level. And then a couple of months later, Centum Real Estate was back in the market for their own bond. So, as I've said, it's a small sample size, but it looks like
it's the trend.
It's indicative. Like if they retire early, it's like they want to give investors confidence that, you see, we are able to pay. We have the liquidity. It's not an issue,
because people still have jitters about corporate papers.
But you see, people learn. People see trends and they learn. Because if you look at that, clearly it's orchestrated. It's not organic per se. Because if you're repaying these corporate bonds using your profits, it would make sense that actually you're capable of paying this money. But if you're using debt, you're literally borrowing from Peter to pay Paul.
Yeah, see, that's what it's called, restructuring.
Debt restructuring. I mean, for me,
would you keep on restructuring every single time? Is it sustainable?
Yeah, it is sustainable.
Come on, Kalia.
My biggest concern,
because especially for a business like EABL, which is
they're a monopoly.
It's but it's heavy cash. It's a heavy cash flow business. They're always, so as long as they're able to generate sufficient cash flows to service their debt, then to service their obligations, they're okay. And based on how big they are, they should be fine.
EABL, I agree with you, is a cash generating business. It's cash rich. If we look at the balance sheet, it has a lot of cash on the balance sheet. But then what poses the problem with the, what do you call it, the liquidity?
Tell you what, Esther, my biggest concern is actually how they used the money, where the money went for this debt. And for me, I see no problem. And this is why. I see no problem, because even don't worry about the restructuring. They're still going to pay. Because if you see where they've put the money, money is going to come back. They bought Serengeti in Tanzania. Money is going to come from that. So at the end of the day, they're going to repay. But of course, the finance cost is usually a very big thing. We talked about that in Longhorn.
That's also another reason why they pay by the to save on finance costs? Why they pay early?
Is it that you do not pay when you retire it early? Is it that for those 6 months that you should have held or investors would have held to the paper, are they losing out on that interest? Because I think, if I'm not wrong, I think for Centum when they paid including the interest. So basically they didn't save on
interest.
On interest. Because as an investor, I gave you money for 5 years.
Yeah.
Why are you telling me that you're going to pay me? I'm not. Me, it's okay. Hold on to the money for the other 6 months. Give me my money in full.
But I saw the implication of EABL retiring its debt earlier than the scheduled time.
Yeah,
was that it saved on finance costs. So again, Kalia, that's something you really
actually
need
I wanted to say that because deductively what we heard from the CFO is that they retired it earlier because it didn't make financial sense. Okay, because it was very high. So that means they saved on
Why
it.
were they realizing that late?
Me, I don't know. Unless I will have to ask. I don't know whether there's anyone who was a bondholder. But yeah, because for me, I don't think they lost out on their interest. So I don't think that particularly saved on their interest. But yeah, this is a follow-up. We can maybe clarify on our social media in the course of the week.
Yeah, sure. I mean, and it would be great to have Rispa here, to have a detailed conversation about this.
Yes.
And the outlook, how it looks like. But, at the end of the day, EABL is powered by Diageo. They all powerfully at Diageo, so, okay.
But you see, if you mention Diageo, you have to... we can't just throw in the name there, because some of these loans, they're... from ABSA, most of it is from ABSA, and they're unsecured. It's just pesa kiasi sana that Diageo
they issued a comfort letter.
Comfort letter,
yeah. So you can just throw in it because they're backed by Diageo, that they're good. Understand?
Yeah, understand.
No, but it gives comfort.
Yeah,
unless
the comfort letter
the parent
said.
company gives comfort letter, and so far we've only seen that happen for a very small proportion of this.
Yeah, because EABL as a business is good. Although you do raise a good point in terms of the working capital. They're independent.
Yeah. They're independent, despite being a parent and a subsidiary. Operation-wise, they're independent.
Yeah.
Another thing, some good news is what is currently happening: the issuance of corporate bonds, Centum Real Estate, Centum itself. Now EABL, and previously again EABL before it issued this.
We also saw Family Bank
successfully doing that.
Yeah,
Acorn also being in the market
exactly with its rates. It shows that the NSE, our boss, is really maturing. It's becoming, it's improving. Yeah.
I mean,
because if such counters can perform this well, because before we come from very old days, very dark days, when Chase Bank,
Imperial, Nakumat,
it was a terrible moment.
Yeah. But so now seeing this happening and and they're not just paying, they're paying before time, ahead of time. It gives investors confidence.
There's confidence in that market, and I'm sure Jeff Odundo is happy on that. But for me, my when it comes to bonds, I think my metric is secondary trading. Is it even active in the bourse in Kenya? I think it's
it is.
If anything, it's non-existent.
Really?
Yeah.
Come on, Kigan.
Secondary trading is not very active, and for me,
I think it's very active, especially for government bonds.
Yeah, I'm saying about corporate paper.
Corporate paper, probably.
But you see, the fact that they're repaying this ahead of time,
it's an improvement. We've come from somewhere, but I'm just saying.
No, but it also
that's where we need to go.
It also reduces the need for corporate trading, for secondary trading, for corporate papers.
But when there is a lot of secondary trading, that's how you know that your market is really developed. There's a lot of things happening. There's a lot of movement. If there's no movement, then there's nothing going on.